I wanted to talk about a topic. This week I had a great phone call with a potential investor, and we were talking about how she can, where she's going to find the money to invest. And we started talking about self directed IRAs. And if you didn't know about self directed IRAs, um, that is something that came along about 20 years ago. The government, of course, set up these government sponsored plans like 401ks and IRAs. Quite a bit ago, and then these self-directed. The law says you can pretty much invest in anything you want. The problem is not every company will let you do that. So if you have a 401k, more than likely, almost positively, somebody like Charles Schwab or one of these big house, they won't let you invest in real estate and alternative assets. They'll usually put in front of you mutual funds and different things that they want you to be in, and they usually only put things in front of you that they own and gather fees off of. They very rarely will let you invest outside of what they call outside of house or outside of their circle of influence. So that's why you need to do a roll. I want to roll over just to anything. You roll over an IRA, or maybe you got an old 401k. You don't work at a business or at a job there anymore. You left a job and you've got some money that maybe you rolled out of a 401k into a traditional IRA, or maybe it's even in a Roth IRA. But in either case, it still may not be self-directed. So you may have to roll it over again to what we call a self-directed IRA custodian. Now, hopefully I've not confused you too much. There are dozens of self-directed IRA custodians out there, and for a fee, they'll let your money sit on their platform where they will gladly let you invest in whatever you want, which includes alternatives. So you could even make a loan to your neighbor who's a fix and flipper guy, and he takes your money, goes and buys a house, fixes it and flips it, and then has an agreement with you to return a certain amount of return to you. You can do something that simple, or you can do what I do, which is find really good operators in really good assets in really good markets, and you can place money with those assets, and your IRA makes him, and all of the funds must come back into the IRA. Here's a problem I got to bring up with my investor is that there is something, believe it or not, it's almost head-shakingly painful, but the government is going to get their taxes. And the way they see it is that an IRA, it's not fair for an IRA to utilize debt and not have to pay taxes. So let's say you are investing in an apartment building, and obviously the sponsor of that apartment building very most likely used debt. And more than often, he used at least 25% equity and 75% debt. And let's say you invested just for round numbers, $100,000. Well, and let's say he gave you an 8% preferred return in the first year. You're going to receive a check for $8,000. In a self-directed IRA, that $8,000 return, 75% of it, the amount that's tied to the amount of debt that he used, 75% of it would be subject to what's called UBIT tax. And I haven't researched this in a while, but there's a sliding scale just like there is for income. And $6,000 of that $8,000 could be subject, or most likely is subject to UBIT tax. And then that scale, let's just say that $6,000, let's say that the UBIT tax was 10%. Well, then $600 would be owed in UBIT. Here's the great, wonderful thing is that you get $1,000 of an exemption. So in the case I just described, $8,000 came into the account, $6,000 is subject to UBIT. If the UBIT for that deal was 10%, it would be $600. $600 is less than $1,000. You are exempt. You don't owe it. That's how it's calculated. I don't know. The 10% number is just something I brought out, but it isn't terribly high. Even if it was 15%, I think that would be $900, and that would be less as well. If it was 20%, you'd be at $1,200. You would probably owe $200 in UBIT tax. So it's not the end of the world. It's a pain in the butt to figure it out. And one way that you can get around UBIT is, instead of rolling an IRA or a 401k into another IRA, or another 401k, you can look at something called a solo 401k. Um, a solo 401k is kind of for sole proprietors. In order to take advantage of that, I think you may have to have an LLC. But for $300 a year in the state of Tennessee, you can form an LLC. It's different all across the country. And that may help you to get a solo 401k, which is kind of for just sole proprietorships. It's not really for people that have employees. And so you could continue to invest in your solo 401k. And for whatever reason in the world, solo 401ks are never subject to UBIT tax. So this is more, I admit myself, I need to research this more. But that is how you get around ever owing UBIT tax. And like I say, it's not the fact that you owe it, it's the fact that you have to figure out every January, February if you owe it or not. And that's the biggest fiasco. You really have to dive into the tax law to see what that applicable rate is. You also have to look at the K-1 from the sponsor, because just because it started out at 75% debt does not mean that it's always going to be 75% debt. After a few years, the debt may drop to only be 60% of the asset's worth. So if the asset is worth 10 million, but there's only 6 million in debt, then the number is 60% of the income you made is subject to UBIT. And then you have to do the calculation and see if you owe UBIT. It's not that big of a deal. I rarely see it be such a problem. Now, when you sell it can get a little arduous when you sell an asset. So let's say that for 4 years you own that same apartment building. You received $8,000 each year, a total of $32,000. And then let's say in year 5, not only did you receive the $8,000, but you received let's call it $52,000 from the sale of the asset. So in the final year, you received $60,000. Guess what? It's subject to UBIT as well. So let's say by the time you sold the asset, only 50% of the apartment building was encumbered by debt. Then the $60,000 you made in the final year of the investment would be subject to 50%. That's 30,000 of that income would be subject to UBIT, and then you look at the sliding scale and see how much. And in that situation, is more likely you're going to owe UBIT. Let's say if it happens to be 20% of 30, that's $6,000. You get $1,000 exemption. Your IRA, I think, would have to your IRA would have to cut a check to the IRS for $5,000. It makes me sick at my stomach, but that's the truth. So you see a lot of people that kind of avoid debt, but it's no reason to avoid it. It's just you need to be aware of it. You also have the solo 401k is a way to get around it. But a lot of people go into these self-directed IRAs and they think they're scot-free on ever paying taxes, and honestly, they're not. Now, in a rare situation where somebody bought a $10 million apartment building and raised all $10 million and did not incur debt, there would be no UBIT. It's the debt that triggers UBIT, and it's really not the custodian's responsibility to identify it. They will usually send you a reminder in the mail and tell you that you may owe UBIT, but it's your responsibility to figure out if you do or not. And a lot of times they'll file it for you, and they have accountants that do UBIT all the time, and it could be $300, $400, $500 just to figure out if you owe UBIT every year. And it eats into your returns, which is kind of frustrating. But if you do have several 100,000 or a larger IRA account, it's not as big a deal. But UBIT does somewhat erode your returns inside the IRA. But more than likely, these assets are making you a lot more money than anything on Wall Street would be making you. It just really puts a bad taste in your mouth to have to pay taxes out of your IRA, but it's a fact of doing business that way. So I hope this helps some of you that are considering rolling money over from an old IRA. If you can figure out a way to get it into a solo 401k, that's the absolute best. If you can't, go ahead and roll it back into another self-directed IRA or a self-directed Roth IRA. I'm partial to the Roth because I would much rather pay taxes today than I would 20 years from now or 30 years from now. That's my opinion. I think paying them today and getting them over with, and that way when you take $100 out of your account 20 years from now, you get $100. You don't owe the government any more money. I hope that's the case. I'm not a big fan of government-sponsored plans because they're government-sponsored, and I think they monitor these things and they know exactly how many trillions of dollars are sitting in 401ks, self-directed IRAs. They've got their finger all over it, and I don't trust that someday they're not going to bankrupt the system and come into our accounts and use some of that money to keep the system afloat. That's a little bit out there, but I just don't trust the government maybe as much as you do. So anyway, I hope this helped. I'm putting together a resource that has about, I've kind of done some research and I have a top 20 self-directed IRA account custodians. If you'd like that document, I would love it if you would comment below this video. Let me know and I will DM that document to you. It's got 20 self-directed IRA companies. It's got pros and cons and where they're located. It really doesn't matter where they're located, but it's kind of cool to see what state they're in. But you can invest with one or transfer an account to any of these. And the pros and cons are really neat. Generally, there are fees, and some fees are higher than others, and sometimes fees are charged per transaction, or a fee might just be a yearly fee. So there's a little bit of information regarding that as well. But these are great vehicles when it comes down to it at the end of the day. If you've got an IRA that's kind of stuck from an old job, it's sitting there and it's only making 6 or 8% a year, and you look and maybe it's getting feed to death and it's had some down years, that's a perfect opportunity to roll that old IRA into a self-directed IRA and get some of your money off of Wall Street and onto Main Street. And actually, when you do that, you're helping the economy in a different way, and you're having a more direct ownership of an asset, which is really cool. It's really neat to be able to drive by something and say, I own a portion of that, and every time they receive rent, I make money or my IRA makes money. So anyway, hope this was a helpful video. Thanks for watching. And again, if you want any of the resources that I mentioned in the video, just comment below and I'll get it out to you.